Tariffs could be the proverbial tail that wags the dog. President-elect Trump will only be inaugurated on 20th of January 2025. However, his well-known policy priorities in terms of tackling inflation, immigration, and to make the US economy great again already has financial markets in flux. Recall that Donald Trump has threatened to levy 60% tariffs on China. Trump may be able to kickstart the process once he takes office, but he is already rattling his saber further. He has threatened 25% tariffs on all Mexican and Canadian goods, as well as additional 10% tariffs on Chinese goods due to illegal immigrants and drug flows across the borders. He has also threatened 100% tariffs on BRIC nations if they try to move away from the dollar. At this juncture, I see a relatively balanced global macroeconomic outlook for 2025, but the risk is that the dispersion of potential outcomes is significantly wider. Hence, simplistic assumptions that the current post-US election euphoria playing out in financial markets in terms of a stronger dollar and higher US equities and higher US Treasury bond yields may not sustain for the year ahead. The material assumption would be whether those Trump policy shifts materialize and if the bite is as bad as the buck. If tariffs materialize and China retaliates and decides to export inflation to the US rather than to absorb the tariff shock, this could prove inflationary for the rest of the world as well. In turn, this could also mean that monetary policy easing space for many central banks may consequently evaporate. The current recovery momentum remains uneven and hence market is skeptical. In the interim, Chinese domestic policy support is set to continue, with Chinese domestic demand the crux to mitigate external downside risks. This backdrop is slightly less supportive of commodity demand into 2025. The other key headwind is that geopolitical tensions remain elevated. The conflict in Russia, Ukraine, and the Middle East persists. The recent developments include the short-lived martial law announcement in South Korea, the no-confidence vote against French Prime Minister, and the upcoming snap polls in Germany. Political uncertainties will have some impact on the real economy because businesses and households will worry about policy stalemates. In fact, geopolitics has replaced inflation as the top worry for central banks and sovereign wealth funds, with 83% of respondents citing it as the main risk to global growth in the coming year, and 2/3 believing that a multipolar order will dominate in the next 10 years, according to a WEF Global Risk Report. The silver lining is that most central banks have embarked on monetary policy easing. The overall disinflation trajectory remains intact for now, but the outlook ahead has a wider tail risk. Should Trump 2.0 prove inflationary for the US economy and the global economy as well, the Fed's leeway to bring policy rates down to their estimated terminal or neutral rate may be shortened. The Fed's path remains highly data dependent. Hence, any data surprises, whether on the inflation or labor market front, will continue to amplify in the days and months ahead. And in turn, other central banks, especially those in the emerging markets, may also take their cue from the Fed. For Asia, the picture continues to be one of general resilient economic health. Third quarter 2024 GDP growth has mostly surprised on the upside, but there are many external challenges that lie ahead. Services was the main growth driver for most of 2024, but manufacturing growth has also started to improve, with the global supply chain recalibration and global electronics demand uptick. The recovery of visitor arrivals also continues. Outbound Chinese visitor arrivals have been growing in numbers, but their spending patterns seems to have changed post-pandemic. There are bright spots within the ASEAN region, with inflows of foreign direct investments and also wealth seeking greener pastures. In summary, 2024 has been conducive to risk-taking. The global monetary policy easing cycle has started a little later than expected, but the global soft landing narrative has largely panned out so far. Looking out from here, whether financial markets in 2025 will continue to sustain, that would require substantial policy offsets to the growing headwinds. ASEAN should remain well positioned for growth, even in a world fraught with strategic de-risking and trade tariffs. Singapore should also continue to see around 2% growth in 2025.